David Burrows is here from Barometer. We're talking North American large caps at 1-855-326-6266. We're off to Oakville, Ontario now for Neil. Thanks for holding, Neil.
Thank you, Michael. Appreciate you taking my call. David, I'd like your opinion actually on Take-Two. This video game maker keeps on making new highs, and I was just wondering how you would enter a position that's making new highs.
Right. So Neil, great point. The stock has rallied from $10 to $100. Mm-hmm. I've used Activision, Take-Two.
What about Electronic Arts?
And Electronic Arts as past picks. This is a great sector. The reason this sector has been so attractive is, of course, obviously the gaming industry is wildly popular, but has gone through this transition over the last number of years where people walking into a store used to go and buy discs, and now they buy them over the web and play with their friends and buy extra weapons and tools online
with real
money for digital tools with zero cost. It's been an unbelievable business model, and so not only have earnings grown, but the multiple of earnings investors are prepared to pay has expanded steadily for this group, and I don't think that that's over yet. So we own Take-Two, we own Electronic Arts, we own Activision. I would average my way into something like this, right? We own it, so we obviously like it. The sector continues to be very strong, and there's lots of opportunity as we go into augmented reality and so on for this market to continue to grow. But, I think you want to pick your spots.
Is this the one, though? You mentioned three major players. Activision Blizzard, I believe, is the world's largest. EA is not too far behind. Take-Two Interactive is the other one, though. And to your point about augmented reality, VR-based games are becoming insanely popular. Do you want to pick one of those three that really is the leader in that space?
So, look, we've taken a basket approach here, and we own all three.
But should Neil, considering he's an individual investor?
And I think that you can make a case in various ways for each of them. They're all somewhat different. So EA is obviously a granddaddy in the bunch. I would buy any of the three because the business model ultimately is the same, and it's a growing pie. So if you're growing your profitability and the pie is growing, it's very, very attractive. It's 40 times earnings, it's 25 times 2019 earnings, but it's a highly predictable business model because it's people upgrading regularly. So I would just average your way into it.
All right. Thank you, Neil, for joining us from Oakville, Ontario. Hamilton now for Dorothy. Hi, Dorothy.
Hi there. I had taken a small position in Shopify about 7 months ago, and I've been extremely pleased. I've doubled my money. And I was thinking of adding to it. Is it too late to add to this, or do you think it will continue to grow? And I wonder what the street consensus is, and also your 52-week outlook. Thank you very much, and I'll listen to your call.
Great.
Answers. Thank you.
So Dorothy, I want to put this in perspective. So technology is obviously a key driver of the market right now, and it's a big sector, and it's important, and you want to have positions there. Remembering that also financials are doing well, industrials are doing well, there's some materials companies doing well. Don't focus only in one sector. Congratulations for having bought the stock. As you know, this is a company we've recommended a couple of times on this show, and we continue to really like it. To put it in perspective, in the last quarter, they went from 400,000 businesses using their platform to 500,000 businesses using their platform. There is probably an addressable market of 100 million businesses who use the platform. Sorry. Went from 400 to 500,000, 100.
100,000 additional?
No, 100 million sites that could use. So they have a 5% market share.
Okay.
They have multiple opportunities to grow the revenue. Yes, they're selling a platform, but they are moving into credit. They're moving into delivery. They are so dominant that Amazon shut down their competitive offering and are now using Shopify. They're selling this service selling their retail products into eBay, into many of the largest branded sites. So this is a company that can continue to grow. And I think that the pie, internet retail, is only going to continue to grow. So this is a company, again, it's an expensive company, but it is the company to own in this space.
Street consensus, though, says that it's already fully valued at this point. Maybe there's $151 in the next 12 months.
Right.
Now, I know you're not a big fan of consensus estimates, but does this suggest that Dorothy ought to be inching her way into this as opposed to jumping in?
Look, I think, again, like I tried to say at the beginning, this is a wonderful company in an important part of the market, but it's not the only part of the market, right? So all of these companies, we talk about Amazon, we talk about Take-Two, we talk about Shopify. You know, for us, these are like 3 and 4% positions in portfolios. So I just want to keep that concept in mind. However, they do have a big market opportunity. Now, on the analyst side, if you think about how many analysts have had egg on their face over the last number of years, they are very cautious about raising their estimates and raising their target prices, very often not until those targets have been hit.
Right.
So those are moving targets, and they are constantly moving them, and in a company that does well, they are constantly moving them higher, so don't get too wound up about that.
Thank you, Dorothy, for the call from Hamilton. We're taking a short break. When we come back to your questions today for David Burrows of Barometer, and when we return, we're off to Vaughan, Ontario to talk international paper.